Ever pondered how to select the best stocks? It's time to play detective. Before buying a stock, dive into the company's details. As a detective, gather clues, analyze data, then make an educated decision. Begin by understanding the company's mission. Ensure it aligns with your investment goals. Next, review the company's products or services. Understand what they sell, how, who purchases it, and its uniqueness. This helps visualize the company's growth potential. Look at how the company stands out in its field. What's their unique selling proposition? This competitive edge often leads to higher profits and a valuable stock. Don't neglect to assess the company's leadership. Strong leaders can drive a company towards success. Research the top executives, their performance, and future plans. Lastly, consider the company's financial health. Examine their balance sheet, income, and cash flow statements. But investing is more than just numbers. Understand the story behind those numbers. What challenges did the company face? What opportunities are there? With these clues, you can form a complete picture of the company and its investment potential. So, the first step to choosing the right stocks is to be a company detective. Gather clues, analyze, and make an informed decision. Remember, great investments begin with thorough research. Next up, let's talk value. Is this stock a hidden gem or just fool's gold? This question brings us to the heart of financial analysis, a process akin to a treasure hunt where your map is made up of financial metrics. Let's start with the price to earnings, or PE ratio. It's a simple yet powerful tool that measures the price you pay for each dollar of a company's earnings. A high PE ratio could mean that the stock is overvalued, or that investors are expecting high growth rates in the future. On the other hand, a low PE ratio might indicate that the stock is undervalued, or that the company is not expected to grow as quickly as other companies in the market. Next, we have the price-to-book ratio, a compass that points to a company's value when compared to its book value. This ratio is calculated by dividing the current closing price of the stock by the latest quarter's book value per share. A low price-to-book ratio could mean that the stock is undervalued, while a high price-to-book ratio might mean that the stock is overvalued. Lastly, we have the price-to-sales ratio. This ratio compares a company's stock price to its revenues. It's particularly useful for businesses that aren't profitable yet, as it can help investors understand how much they are paying for each dollar of a company's sales. Think of these ratios as your shopping list when you're out looking for the best quality stock at the best price. It's like being in a boutique where the items don't have price tags, and you're trying to figure out which designer dress is the best value for money. You wouldn't just go for the most glittery one, would you? Instead, you'd check the material, the stitching, the brand, and yes, the price too, before making a decision. So, when you're evaluating stocks, don't just go for the ones that are making the most noise in the market. Look beyond the hype, beyond the glitter. Use these financial metrics to uncover the real value of a stock. After all that glitters is not gold. Don't get dazzled by the market glitter. Make sure the stock's value truly shines. Now let's ride the beta roller coaster. Imagine the stock market as a giant, unpredictable roller coaster. Each stock is a seat on that ride. Some seats are wild, tossing you about with every twist and turn. Others offer a smoother, steadier journey. This is the concept of beta in the world of investing. Beta is a numerical value that measures a stock's volatility compared to the overall market. In simple terms, it tells you how much a particular stock swings up and down relative to the market as a whole. Think of beta as your market mood ring. It gives you a sense of the stock's temperament, its mood swings, if you will. A beta of 1 indicates that the stock moves in sync with the market. If the market goes up by 2%, so does the stock, and vice versa. But what if the beta is higher than 1? Well, that's where the ride gets a bit wilder. A high beta stock, say of 2, means it's twice as volatile as the market. Picture a seat on the roller coaster that not only follows the ride's ups and downs, but amplifies them. A 2% rise in the market could mean a 4% rise for this stock, but a 2% dip could also mean a 4% drop. High beta stocks are not for the faint-hearted but can offer bigger rewards for those who dare. On the other hand, a stock with a beta less than 1 is like a seat on a carousel. It's still part of the amusement park, but it's a much smoother ride. These low beta stocks are less volatile than the market. They may not provide the thrill of high beta stocks, but they offer stability and are less likely to give you investing whiplash. So, what's your investing personality? Are you a thrill seeker, ready to ride the highs and lows of high beta stocks? Or do you prefer a steady, less dramatic ride with low beta stocks? Choose your adventure based on how much market excitement you can handle. Who doesn't love a bonus? That's what dividends are in the stock world. Now let's unwrap the gift of dividends. Simply put, dividends are a portion of a company's earnings distributed to shareholders. Imagine a pie, the company's profits. Each slice represents a dividend. The larger your share, the bigger your slice of the pie. But why do companies distribute dividends? Some businesses, especially those with substantial and consistent profits, choose to share their success with their shareholders. This gesture not only attracts investors but also builds trust and loyalty. It's their way of saying, "We're doing well, and we want you to be part of our success story." Let's now dive into the role of dividends in providing steady income. Consider this. You invest in a company that regularly pays dividends. Every quarter, or sometimes every month, you receive a portion of the company's profits directly into your account. It's like a paycheck for being an investor. Over time, these payments can accumulate and become a significant source of income. And the best part? You receive this income whether the stock price goes up or down. Now, this makes dividends especially attractive for those who prefer a set-and-forget investment strategy. Here's why. You invest in dividend-paying stocks, then sit back and relax. The dividends roll in regularly, building your wealth without you lifting a finger. It's like planting a tree and enjoying its fruits year after year. But remember, not all dividends are created equal. Some companies may offer high dividends to compensate for their low stock price or poor performance. Others may have a stellar track record of increasing their dividends year after year, so it's crucial to do your homework before investing. Look beyond the dividend yield, dive into the company's earnings, payout ratio, and dividend history. So, there you have it. The power of dividends, turning your investment into a potential money-making machine. They might just be the secret ingredient to spice up your portfolio and bring you closer to your financial goals, so keep an eye out for these cash cows. Finally, let's decode the mysteries of stock charts. Imagine you're a detective and the chart is your case file. Each type of chart is like a different language, each with its own unique set of clues. First, we have the line chart, the simplest of all, showing a stock's closing prices over a specific period. It's like a breadcrumb trail, showing you where the stock has been, which can provide insights on where it might go next. Next up, we have the bar chart, a bit more complex, revealing the opening, closing, high, and low prices for the stock during a specific period. It's as if you're peeking behind the curtain, getting a more detailed view of the stock's performance. Last but not least, we have the candlestick chart. It's like the bar chart but with a twist. The body of the candlestick shows the range between the opening and closing prices, while the wick shows the full range of prices for the day. Green or white candlesticks indicate that the closing price was higher than the opening, while red or black candlesticks show a lower closing price. It's like a secret code, revealing the stock's mood swings throughout the day. By learning to read these charts, you're not just following the stock's journey, you're predicting its future. You're becoming a stock market sleuth, using these visual clues to make intelligent investment decisions. Think of yourself as a chart detective uncovering clues to make smart stock choices. And there you have it, your 5-step guide to picking winning stocks. We've journeyed from diving deep into company knowledge, through evaluating true value beyond the hype, riding the beta roller coaster, appreciating the power of dividends, and finally mastering the art of stock charts. Each step is a crucial piece of the puzzle to becoming a savvy investor. Remember, in the stock market, knowledge isn't just power, it's profit. Stay smart, stay invested. P Finance. Empowering your finances $1 at a time. Thank you for watching.